The changes made in the budget, or at least some of them, remind us of the importance of advice in helping people to make difficult choices. That's what people will pay for. People won't pay, self-evidently, for stuff that they can easily and cheaply do themselves, but they will pay for stuff that is complex, where the consequences of doing it yourself and getting it wrong are economically disastrous, and you can't readily self-serve the answer. And I think a couple of those changes made in the budget, particularly the ones to the introduction of the LISA, the lifetime ISA, and the changes to capital gains tax, it caused us to focus on existing choices and to consider new choices. So to recalibrate thinking on existing choices that people will pay for, and to consider the new choices that particularly the introduction of the lifetime ISA generates for us. We need to consider those things. So I'd just like to spend a little bit of time looking at those two elements, the introduction of the lifetime ISA and the choices that that gives rise to, and the CGT changes, and effectively the recalibration of existing choices that I believe is necessary as a result of that, together with, of course, the changes to dividend taxation. So LISA, first of all, obviously the most blatant choice that you have to consider is lifetime ISA or pension. The lifetime ISA has been put forward as a potential pension savings vehicle, obviously because if you save up and don't take your money out until age 60, sort of roughly close to what someone's retirement age, whatever retirement means these days, is, then let's consider that as an alternative, as a means to saving up for a pension. There's been a bit written about this already. How do they compare? Well, they're quite different vehicles. The pension, of course, gives you tax relief on the way in, an authorised pension that is, gives you tax freedom on the underlying fund, but then the price, as it were, that you pay for the tax freedom on the way in, the tax relief on the way in, is, of course, the amount you take out is subject to tax, save for the first 25%, the pension commencement lump sum. The LISA, on the other hand, is based on the so-called TEE model, where there's no tax relief at the front end. You still get exemption on the underlying funds, so the same as the pension, but then you pay no tax on the way out. The LISA has an extra kind of supercharge, which is, as well as tax freedom on the way out and tax-free growth, you also get a government bonus, which equates to a flat rate of relief of 20%. So when you're measuring ISA v pension, there are some things to take into account. On the pure tax front, the pension, especially if you're a higher rate taxpayer or an additional rate taxpayer, will give you more to invest at the front end. But if you're paying tax on the way out, then that won't look so good when you measure it against a LISA, where you get some tax relief at the front end effectively, but no tax on the way out. You just need to do the numbers. The LISA certainly will play well for a basic rate taxpayer, where we're looking at, you only get 20% relief on the way into a pension anyway, and you get that under the LISA, but you also under the LISA get no tax on the way out, whereas under the pension you do get tax on 75% of what you remove. There'll be some need, as I say, to do the numbers. Accessibility may be another thing that drives a person one way or the other. You can take your money whenever you like from a LISA, but you need to bear in mind, if you take it out before age 60, other than to use as a deposit for a first home purchase, then you are going to suffer that penalty, that withdrawal of the bonus, withdrawal of the growth on the bonus, the so-called bonus element, and a 5% penalty. So you need to consider, yeah, it is accessible if you need to, but you're going to need to think carefully about the impact that bonus will have and factor that into your numbers too. It may be possible to, and consultation will take place on this, to borrow money from your LISA up to a limited amount, following the US 401k model. We'll have to wait and see. So there are some of the things you consider in relation to pension or LISA. And of course, you're only considering it to the extent that you can invest in the LISA. So it's only in respect of £4,000. But for a lot of people, that will be an important decision to make. When we're looking at another vehicle that you could consider as an alternative, there's the Help to Buy ISA, which we already have and will be with us until 2019. So that is in relation to one aspect of the LISA, which is the ability to withdraw money to use as a deposit for a first home, leaving aside the saving up for pension aspect of a LISA. So there we've got a direct choice of Help to Buy and LISA, at least until 2019, which is when the Help to Buy ISA is available to. So I think there'll be a period of 2 years, from 2017 to 2019, where you could do one or the other, and a decision would have to be made. The government probably would be quite keen that people would roll Help to Buys into the LISA, and are making it attractive to do that with the ability to retain the bonus under the Help to Buy and the LISA if you roll the Help to Buy amount into the LISA in the 2017-18 tax year, the first year the LISA is available. Again, more detail on that will come through as we see the finance bill and the consultation that goes with that to lead to the final legislation. There's a lot more detail on that on both of those considerations, LISA or pension, LISA or help to buy within Techlink. Some quite detailed bulletins showing you the factors that you'll need to take into account. So I'd recommend having a look at that. Moving to the CGT changes, that was an unexpected change actually, the dropping of CGT from 28 to 20% for higher rate and additional rate taxpayers, and the dropping of CGT from 18 to 10% for basic rate taxpayers. So what choices to this effect? Well, for investors, it's really an important part of the expected return on investment is capital gain. Of course, you've got growth and you've got income. In relation to income, I've already talked about in past videos the significant changes to dividend taxation that we will experience, hopefully enjoy, from the 2016-17 tax year. Now we have also in the 2016-17 tax year CGT changes with those reductions I've talked about. So how do you factor those into decision making on collectives, unwrapped or investment bonds? Once we're beyond the kind of tax no-brainers of pensions and ISAs and LISAs, which give you that sort of tax boost, if we're looking at the investment choice beyond that, then you factor those two things in, income and growth, into the consideration. Once you've decided I can get the portfolio I want within a bond or within an unwrapped investment. So how are they going to play in? Well, again, you'll need to do the numbers, and the relative importance of capital gains tax will depend on the importance of growth in the particular portfolio you've got. Some have suggested also, from a tax standpoint, if capital gains are taxed at such a lower rate compared to income tax, for example, if you're a high rate taxpayer and paying 40% on income, once you've exceeded your dividend allowance, of course, which is £5,000, then you could get only 18% payable on your capital gain. That's half the tax rate. However, of course, it does bring up that more important and fundamental consideration. Do you go for capital growth to the expense of income on the underlying portfolio, which implies a much greater element of risk because there's a lot more volatility attached to the capital growth, of course. It's been proven year after year after year. The Barclays Equity Gilt Report reminds us of it year after year after year, that there's a significant importance attached to reinvested dividends in driving long-term investment performance. So those capital gains tax changes need to be factored in. I would think they probably won't determine the investment portfolio choice, i.e. greater shift towards focus on capital growth and income, but they would need to be factored in relation to the choice of whether to wrap the investments into an investment bond or not. In relation to unwrapped investments, when you consider the combination of a lower CGT rate and £5,000 of dividends tax-free, at least up to the CGT allowance, exemption, and the £5,000 dividend allowance, the case for collectives unwrapped stands pretty much unchallenged. It's once you get dividends above the £5,000 allowance and capital gains above the CGT exemption, although factoring in, of course, that rate is now going to be lower, that the bonds will come into consideration. So more on this within Techlink, detailed discussion within Techlink bulletins. I would encourage you to have a look at that, to be equipped to have those discussions with your clients and your professional connections.